Nice.
Yeah, if you remember. That's where Jeremy does his.
Yeah.
Oh, really?
Yeah. Yeah. I mean, I had him come up here. So I did an episode with Jeremy, and
he's great, by the way.
Dude, I love that guy. Like, I just want to give him a big old hug. I actually met Scott for the first time today.
Who?
His
I've never met.
It's his brother-in-law and business partner. Super, super nice guy. I had lunch with him today. Kind of a quieter guy. Jeremy's definitely the sales guy.
Yeah.
He's kind of the big energy, and Scott he's the operations guy and clearly really smart. But what was it going? Jeremy he brought me on the podcast. We did an interview, and he wanted to talk about my experience with property management. Given my history, it's been rocky to say the least. And I did my episode, and I think I was fair, but like kind of talked about it and was like, hey, at the end of it, like, I still use a property manager. He sat on it for like 2 weeks, and then he reached out and he's like, hey, I can't post this because I don't think like we did a good enough job of framing like why you still use a property manager despite all this. And like, if I was listening to this, I would never hire a property
Yeah.
I'm like,
especially if it's a property manager that's doing the podcast.
Well, and like,
not a good brand.
Yeah. And so he actually came up, we did a 2-parter on contractors, and we did it here, contractors and property management. And that was a really good conversation. I think we did a better job of like, hey, I'm a once in a million times 2 type of situation. So like, don't have that be your expectation. And just work with people who aren't starting out. Kind of the advice is like, if they've been doing this for 16 years, they're probably going to be doing it in a couple.
We just lost our good partnership with them, but Devin. Yeah, Devin left. Devin Shaw. Julius. Is it Julius?
Yeah, Julius.
Yeah. So I think he works pretty closely with John already. So
yeah, I saw John the other day at Tyler's event, and I thought Tyler was going to get into a fist fight with Julius there.
All right, we are live.
Yeah.
Just giving you a heads up.
Is anybody watching?
Not at the moment, but it's still recording.
Hey, agents move.
Yeah.
Agents move brokerages. Yeah. It's part of the game.
Yeah.
I can't spill too much tea.
Yeah. Yeah. Soft intro. I think everybody, if you're watching, you know that we put out a bird call that Jared Shore was coming on just to talk about some of the current rates going on, talk about what Mamba's doing, and good for us too, because I think we need a refresher as well on what the latest stuff is really, because I don't think we've talked to you here in a little bit. So
really to also clear some misconceptions out there. What's going on in the mortgage world, because a week or so ago when all the headlines were the Fed cut the rate and everyone was going nuts. And then I kept hearing different information from people who weren't lenders. So it'd be nice for you to kind of give everyone an update on what that means and what that looks like for people. So
and if you're watching on YouTube, send in a question. We'll pull it up on the screen and we'll have Jared answer it as we go.
Sure. Well, first of all, thanks for having me back.
Yeah.
So cheers, everybody.
Yeah, cheers, boys.
Our first returning guest, I think.
So.
Yeah.
Well,
first guest and first returning guest. Listen, let's just keep this rolling.
All right. So I think what's important though, for anybody who might not know you, I know you're probably the best branded lender here in Indy, but like specifically, kind of what's your background? What kinds of products do you offer? What kinds of products don't you offer? Just so people have an understanding of kind of like who you are.
Yeah. So I think if you watched it last time, we've expanded a lot of what we offer. So we are, a quick background, I've been in lending for 10 plus years now and worked for, the retail lenders, some of the bigger banks, and now kind of broke off and we are in the broker world, which is the mortgage world is moving towards brokers. Brokers were kind of the what everybody did back in 2006, 2007, 2008 happened, kind of shut the broker world down. Everybody went to retail, and I think brokers are about 25 or 30% of the business right now, and it's growing. So the difference between, I guess, a retail lender and a broker is we just have more options. So we do what everybody else does in the lending world. We just have different lenders on the back end that we get to work with and price it out for you, and then figure out what's the best deal for you. So you actually save quite a bit of money by using a broker. So from a product perspective, we can do everything. There's really not much we can't do. So we can do conventional FHA, VA, USDA.
You were not doing conventional before.
We were not doing conventional. So that was really at the end of last year. We did that, and which we looked like heroes because we did it right when rates started to drop a little bit. And so it was just good timing. It was by pure accident on our end, but it was good timing for us. So yeah, everything conventional, primary, anything second homes, investment properties on the conventional side we can do. And that's where really everybody that works for us, and myself included, we grew up in that world. That's where we, our bread and butter in terms of knowledge is the conventional side. What we love to do the most, though, is the investor side, which is your DSCR loans, your debt service coverage ratio, your hard money loans. We can now do HELOCs on both investment and primary residence. So
nice.
Lots of unique stuff. We can do land loans, ground up construction for investors. There's really not much we can't do. So product wise, we've expanded to a point where we want to be the go-to for anything.
Yeah. Well, it sounds like you've got the products to do it. So
We're trying.
Yeah.
Yep.
But dude, that's really awesome. So are you willing to kind of give us a summary of like what has been happening here in the news recently? What the heck is going on?
Yeah. So the 18th of last month, Feds dropped the rates by 50 bips or half a point. And it was the first rate drop that the Feds had done since 2020, I believe. So it'd been almost 4 years since there was any kind of rate drop, which is great, right? It's awesome for everybody. And really what I think, the misconception is that, it directly affects mortgage rates.
Right.
And it does and it doesn't. And I think, ironically, the next day after they dropped rates, mortgage rates went up a little bit, right?
Everyone's like, what's going on?
And it's like, what's going on?
Yeah.
And really what happens is, all right, so as the economy shifts, right, if you have a choice to put your money, if you're an investor, in the stocks or bonds, right, which is the safer bet? It's bonds, right? And mortgage rates are triggered off of the 10-year treasury bond. So when the market is bad and interest rates are, not as good, they're going to pull their money from, or if there's things bad going on in the economy, they're going to pull their money from stocks, move it over to bonds, which drives the bond market up, which has an inverse effect, which drives mortgage rates down.
Gotcha.
When good things are happening in the economy, people pull it out of bonds, put it into stocks, and so now you have and it doesn't always hold true to that, but theoretically that is what is happening.
Okay.
So, but lenders also know they preemptively drop rates when they know something's going to happen. So we saw rates on the mortgage side drop 2 weeks prior, right? And so it was nice for us. Rates were dropping. Kickstarted a little bit of business for us. Then when rates actually dropped at the Feds, we saw rates go up, and that's just because rates were right sizing themselves from where they had dropped them to where they were after the Fed. So long story short, rates are going down both on the mortgage side and on the Fed rate, and the Fed rate really just impacts your short-term lending, HELOCs, auto loans, things that are short-term. It doesn't necessarily affect your long-term lending like mortgages, but as a result, it does.
Gotcha.
So I don't know if that answers your question or not. It's a much more complicated answer than that, but at the end of the day, rates are what they are.
Yeah.
If I could control the rates in the market, I would. We'd all be in the 4s and 3s.
Yeah, I would love if you could control that.
Yeah, that'd be great.
Let me tell you, you did my primary with a previous company, and let me tell you, it's a little bit better than the rates we're getting.
Yeah. What year was that?
2021.
Yeah.
I think we were in the high 2s.
I bet.
Yeah.
The lowest we ever locked somebody was a 1.75 is what we
15,
got.
15 year?
30.
30 year?
30 or 1.75.
Jesus.
Yeah.
Wow.
No. Scraping
That's incredible.
Yeah.
They'll probably never move.
No.
Yeah.
Dude, I mean, so many people are trapped right now.
Yeah.
Like,
Yeah.
for instance, we love our home. It's an awesome house, but like there are a couple of things that's like, I kind of wish we had one extra bedroom kind of thing. And we can't move.
No.
Like we cannot move because our mortgage is so
Yeah.
cheap. And for the same house today, we would pay twice as much.
Yeah. It's crazy. Yeah. And that's part of the problem in the market right now is there's nobody that really wants to move out of their house. They're just going to go buy a cheaper house for more payment, right? Because of where the rates are. So people are, quote unquote stuck. And then you have this influx of new home buyers that are coming on the market that want to buy, first time home buyers, and there's no houses to buy. And they're okay with paying a higher rate right now.
They've already accepted that.
Yeah, they're like this. Yeah. They don't know, what the market was a few years ago. So this is just their world. And while we're all like, oh my God, it's a high interest rate, they're like, oh, we'll just take a house. Like, just get us into a house right now. And so it's a great time for first time home buyers to buy because there's not very much competition with other buyers. And so they can get into a house fairly cheap, and then they can refinance later. But yeah, we're in just a weird shift in the market.
Yeah. Well, are you able to prognosticate? Like, I know, there's talk of potentially more drops in the future. What would make additional drops happen to keep those going?
I mean, so you'd have inflation stabilizing. It just kind of depends. I don't. It's funny, people. I'm a mortgage guy, right? I don't pay attention to the rates as much as what most people probably think I do. Because again, I can't control the rates. We can only control what we can control. But yeah, the economy is going. It's an election year too, so we kind of anticipated this over the last year and a half that rates were going to drop. Every year that there's been an election year, rates have gone down. It just took a lot longer this year for it to happen. The Feds have not indicated whether or not they're going to drop them again this year. They've indicated they might, but they're very hush hush about it. So we didn't know if they were going to do anything, on the 18th, or if it was going to be 0.25%, 0.5%. They went with 0.5%. I'm crossing my fingers. It's going to be another 0.5% by the end of the year. Yeah. That'll set us up for a pretty good 2025.
That's awesome.
Yep.
So, so you're saying basically it's a better time to refi right now, right? If you want to do that, it's to take advantage of the lower.
Yeah, I mean, there's risk, right?
Yeah.
Because the risk is if you do it now, what are the rates going to do in 6 to 12 months from now?
Yeah.
And so I think you gotta tell yourself, am I okay with doing it now? Is there enough movement with my payment and cash flow if you're an investor, right? Depending on when you bought too. Like if you bought last year, you might be in the 8s right now and being able to get into the 6s depending on what you qualify for.
Yeah.
It's a pretty big jump in rate. And also loan amounts, like the lower the loan amount, like rate doesn't have that big of an impact on the payment. So there's a lot of, I guess, variables into that, but I'm not a risk taker. If I know I've got something right now, I'm going to take it. And if it drops another 0.25%,
so like in Nick's case, he loves his house. He wishes he had one more bedroom.
Sounds like I got
to. He could pull some money out, add a bedroom to his house. Like, are people doing that, or like people who just like, hey, my mortgage, I love it right now. I don't want to move, but I need something.
Somebody who's in a really, really low interest rate that bought 2020 or refinanced during the COVID years. HELOCs are coming back is really strong. That used to be a product that only your credit unions, local banks offered and had really good terms on those. All these lenders out here, they realized we need to open up our product line or we're going to lose all this business because all these people, they're not going to refinance and there's equity to tap. Right. Yeah. And so HELOCs have been a huge deal. HELoans are another one that's a huge deal.
Do you mind actually differentiating between those?
Yeah. HELOC, think of HELOC which is a home equity line of credit. It's a giant credit card. It's just a second mortgage on your house.
Secured by the house.
Secured by the house. You use it like a credit card. You can pay it off. You use it again, pay it off. A HELoan is just a second mortgage. You take 30 grand out, whatever it is, 30 grand out, you get it and you pay it off and it's done. It's just a regular loan. It's not a revolving.
Why might somebody pick one over the other?
A HELOC, a lot of people will use a HELOC if they don't need all the funds right away. Maybe it's more of an emergency case. Maybe you don't have to pay on it, right? If you don't use it.
You pay for what you use.
You pay for what you use. A HELoan might be a better option. It's a fixed rate mortgage as well.
Cheaper generally?
It depends. It can be cheaper, But let's say you're redoing your kitchen, 100% you need $75,000 to redo your kitchen. You're going to use it no matter what. So whether you do a HELOC or a HE loan, you're pulling that $75K out.
Mhm.
A HE loan is going to have a fixed rate over a fixed term, whereas a HELOC, you've got to pay interest only for a certain period. So you're not paying that loan down unless you start paying extra. And then after a certain period, it turns into a 20-year, 10-year loan, depending on the terms. So it's long term, it's a lot more expensive to do a HELOC unless you're paying it off in advance.
Yeah, that makes sense.
Okay. Yeah.
But there's a lot of second mortgage options that are coming out that we didn't have before.
And potentially dumb question here, and I'm sure it varies, but like for the most part, what could somebody expect from a term perspective on like a HELOC, HE loan type of situation today?
Yeah, it depends. Let's for investment properties.
Let's
Or
do
primary.
primary to start, and then let's move over to
Yeah. So probably 6, 7, 8%. It's usually a couple points higher than what the market fixed rate is.
And then loan to value.
I mean, all
I know the questions, dude.
Yeah. And the problem with us being a broker is like we have all these different options, and they can vary between. So typically, let's say 90% combined loan to value. That's going to be your mortgage plus the new HELOC.
So basically, somebody could sell the house and still they pay it all off without being underwater.
Yeah, correct. Yeah, they're always gonna leave a little bit of equity in there if you're doing any type of cash out. So 90%, some of them, depending on credit score, limit you to 70, 80%, whatever it may be.
Gotcha. That makes sense. And how about on the investment side?
Typically 70% combined.
Okay.
And rates are trash. Think hard money right now, probably 11, 12. I've seen some of the 13%, which depending on loan amount and what you're needing it for, it may not be a bad option, but I got asked all the time a couple years ago, who's the best HELOC lender? There was like one in the entire country that would do investment property HELOCs. They've opened that up, and I think they're higher risk, and so they're slowly getting into it. So the terms on those, my assumption is they'll get better as more people use it and they see payments are being made on it. The risk factor, they've got a bigger pool of loans they can pull data from. But right now that it's a fairly new product in the market, or it came back as a new product, I should say. And so the terms just aren't as favorable, but they're there, and they're not a terrible product. It's just it's property and person specific.
Why would somebody use that as opposed to just going and saying, "Hey, I'm buying an investment property. Here's what I got. What can you lend on this?" Because it sounds like there's no upside really to doing it that way.
Well, let's say you're cash poor, house rich, if you will.
Okay, that would make sense.
And so let's say you've got another property you want to buy and you've got equity in a property. It's a quick way to get, maybe you got a free and clear house and you don't want to pull all the funds out of it right away.
Mm-hmm.
Take a HELOC out on it. And if you essentially you're financing, if you're doing a hard money loan, let's say, all you're doing is you're financing it on property A as opposed to new property B.
Yeah.
So it's the same. So if you know you're going to be able to pay it off, it's a great tool.
Okay.
It's just not a great tool if you're going to keep that debt for 10, 12 years paying that interest.
Gotcha. Okay.
I'm going to be selfish here with this next question because something that's in the back of my head. Do you guys do any type of new construction type loans or anything like that?
Yeah. We do it both for primary and for investors.
Well, all right. So I'll just put this out there into the universe because my wife is going to make me do it. So I've got this awesome lot in Fishers. I don't know if you've actually been out there at any point.
I've heard you talk about it.
Yeah, it's 3 acres out there in Fishers. It's got 2 crappy brick ranches on it that they need to get torn down. They do fine as midterm rentals, but it's a wildly underutilized space. And so one of the things I want to do is, and I've never done the ground up construction myself, is on part of it do townhouses, and on part of it do the primary.
Mm-hmm.
The primary from all hell that my wife is going to spend all the money with Paul.
Yeah.
What do terms on something like that tend to look like? I have no idea. I've never even looked at new construction loans.
Typically, they want to see experience that you've done ground up construction before. However, if you've never done ground up construction, you just need to have a couple flips under your belt. I've done a couple.
You've done a couple
flips. So think hard money.
Okay.
Typically 85% will lend on the construction cost.
Loan to cost.
Yep, loan to cost. And then
Now, if I
instead
run
of
a
an
construction company and I could like make the invoice say whatever I wanted to
100%.
say. All right, cool.
Yep.
I'm with you.
All right. Sounds like you're onto something now.
Yeah.
Usually 70% of the after construction value is what we'll lend. So it's just like a hard money loan. It just kind of depends on, again, experience. Yeah. So I brought this one too.
Okay.
Yeah, I don't think he heard you talking about it.
No. It's
Well, might as well stick to the Jack theme.
So I'm gonna. There you go.
I saw your glass was empty. I got nervous.
Yeah.
Like I thought that the conversation ended once the glass was empty. So
No,
I didn't want anything to
Thank
end.
you.
You bet. So this is Jack Daniel's Bottled in Bond. Whiskey Advocate magazine said it was the highest rated bottle underneath $50. Like a 97 rating. It's like a $30 bottle. So
Love it.
I went and bought it. I found it. Yeah, and opened it up the other day. Tried it, and it does not disappoint. It may be the best bottle underneath $30 I've ever bought. Yeah.
Wow.
And you've tried a lot.
I've had a few.
That's
I've had a few.
And this, you just at Meyer or something like that?
Yeah, just anywhere.
Okay. Didn't know if it was like hard to
Ooh,
find or something.
Good nose on it too. It's got that banana. Jack is known for, right?
Mm-hmm.
Yeah, I guess we should talk a little bit more about bourbon in some of these episodes, like we did at the beginning. We haven't been good about that recently.
No. I mean, we were just drinking the Jack 12 a minute ago. That's
The great thing with bourbon is it's so regulated, right? That there's not bad bourbon.
oh,
I've had a couple
I've
bad
had some bad
bourbons.
bourbon.
Well, okay.
But I know what you mean.
Yeah.
Yeah.
It's
Like-
if it doesn't
You
pick
can
your palate,
Like
right?
the worst ones, you can say I could tolerate it. You know.
You know what? I've got a bottle. I'll give you, and you can have it. It was not a cheap bottle, and it is trash.
What is it?
What is it?
All right, I can't remember what.
Me and you
brand
had it together, I'm sure.
Yeah, I think we did. It was the same company that did the one you like that has the "It's great" on it label.
Oh yeah.
But it was the red corn or whatever.
Is that frosted?
You're
Flakes?
right.
That
Yeah.
that's trash.
What are you talking
I
about?
remember that
Uh,
because I tried it at the liquor store with you, and I'm like, yeah, this is
I think you tried it at my house, and you're like, "Thank God I wasn't the idiot who bought that."
Brooks was hungover the next day.
probably.
What's your favorite bourbon you ever tried?
Ooh, favorite. All right, so that's a good question. My favorite distillery is Rabbit Hole, and they have their Derringer.
Derringer?
That's
Derringer?
yeah. I remember I got you a bottle of that when you helped me buy my house.
Stuff's great, man.
But they had a founders collection
Mhm.
version of that. At some point, I'll have to have you over to the basement. I don't bring it here because I don't want other people pouring it. But
Kia's saying hi.
what? Huh?
What's up?
Hey, Kaya.
Oh my god, our first live
Yeah,
comment.
shoot.
Let's
You
go.
need to ask good questions though. But I've got the founders collection at my house, and that is unfreaking real. It is so good. How about you?
So last year I had the opportunity to try William LaRue Weller, the 2019 version,
son of a
and
bitch.
I didn't want to drink it. Like because it's like my unicorn.
Hey,
right?
that's my unicorn bottle.
Right,
Like,
and then-
I want to try
and
it.
then he poured me at like a solid glass, and it was in Dayton. Shout out to Ben Felt, and
Is it everything?
it's everything.
I
I didn't want to try it because I didn't want to be disappointed.
It's like you've
And I was-
overhyped it in your
And
head.
I was not disappointed. It's so good.
It's
So
I've seen
good.
it for like $200 for a pour, and I couldn't justify it with my wife watching.
Yeah.
But yeah, that's one that I will for sure.
It was
have one
great.
day. Okay.
It was
Okay.
good.
How about you guys? Favorite bottles, and then we can get back to lending.
Man, I tried a lot. My last trip to Louisville, tried a lot of great bourbons. But I'll just say my favorite to keep at home and I guess have a good night with would be Blanton's.
You can't go
That's-
wrong.
Yeah, that's like my go-to. Wish I could find it a lot
Okay, good
easier
luck.
than what you can, but that's always kind of been
Blanton is great.
it's been my favorite ever since I've tried it.
How about you, Brooke?
I'm always an Eagle Rare guy. Just it's easy drinking. I mean, it used to be $30 a bottle. You could find it everywhere. Obviously, it's harder to find now, but that and my two favorite just everyday drinkers are are probably the Russell's 10.
Russell's 10.
I was going to say, you better say Russell. It's one of them. It's the
I have that at home.
And yeah,
I have it right there.
and I honestly, after I went down and visited, why am I blanking on the name of it? Shoot, it's Blade and Bow. After I went down to Louisville and
That's such a cool distillery.
and visited that distillery and their little bar right there, they make a lot of their stuff out of the Blade and Bow. I saw you had it up there. I almost grabbed it. That's been one of my everyday drinkers.
You won't believe this about me, and I'm almost embarrassed to even say this, but I'm going to say it. I've never been to a distillery. I've never been to Louisville. I've never,
You've never been to Louisville?
When's your
I've been to Louisville.
Jared, when's your birthday?
Yeah.
I've never taken any distillery tours down.
You should.
Down the Bourbon
You would
Trail.
enjoy it.
Once you do three though, then you're kind of like done with the tours, and it's like, can we just do the tasting?
Yeah.
But
Where's the tasting room?
yeah, no, like my wife and I used to go down and like do every tour, and now we're just kind of like, all right, can we just do the tasting? Like we know how bourbon is made at this point. Let's move on to what we're here for. But Stitzelweller is far and away one of the best. Buffalo Trace is another great one.
Mhm.
Four Roses is
Yep.
awesome. Maker's Mark is awesome. Dude, you can't go wrong with any of those. And I'll throw Four Roses back in the like always a banger.
Yeah. I did that last time when I was in Lexington. We actually didn't get to do the tour, but because they were all booked up, but we did the tasting room or whatever.
So
And yeah, I've been on for a Four Roses kick as well.
Yeah.
I've always liked it. I've always had it on my shelf, but it wasn't something that wasn't my first pull if I was going to Meyer or something, you know.
I'll throw out too, like Hard Truth has been coming out with some bangers, and that's down in Nashville, Indiana.
You're right about that.
Like I've got their two newest bottles over there, and they've
Mhm.
been fantastic for the price. And it's like kind of nice to support like a local small
Yeah.
distillery.
Yeah. For a while there, I was like, man, everything they have is just way too sweet.
Yeah, it was not great
Yeah.
for a while.
Starlight's got some good stuff too.
Oh yeah,
Out of where I don't know where they're at, just north of Louisville.
Yeah.
Because they're technically Indiana
They're
as
in
well,
Indiana.
right? Yeah.
They're Indiana.
They're like on the north side, right?
Mhm.
Yeah.
Yeah. We need to.
We were supposed to do a tour there at some point. I can't remember what got in the way.
It's a pretty.
Can we do a podcast in Louisville, guys?
Yeah.
Yes, we absolutely should. And actually, I was sitting here thinking about it. I'm like, man, we should probably go up to like West Fork and do one there.
West Fork, yeah.
They have a cool tasting room.
They have a cool just facility right there, and they're
Mhm.
expanding it.
Yeah.
Are they expanding
Their
it?
burnbon isn't to
They
my
need to.
taste. For the
Everyone
most
like
part.
on
but
the
the
weekends,
experience
there's
is cool.
lines
Yeah,
out
it's
there.
so-
You can always drink bourbon if it's mixed with something.
Oh
you know?
yeah, absolutely. I will tell you, I had an employee. We're celebrating our 1 year anniversary this week. Very excited
Which,
about
by the
it.
way, congratulations.
Thank you. Yeah.
Yeah. We should do a cheers to that.
Yeah.
And you.
Yeah. Yeah.
1 year.
1 year.
Actually, 1 year for all of us.
We're a couple months late, but yeah, I love it.
1 year for all of us. Yeah.
BR buys in.
Oh, yeah, absolutely. And so I opened up a pretty special bottle for us that I'd been saving for a while. That my connection chip had hooked it up, and it was really nice, and it was going great until I realized that this employee mixed this very expensive bourbon with Coke Zero.
Mm.
This wasn't like 2 drinks in, 3 drinks in. It was 1 drink, like half a drink. He was mixing this. I was furious. I could not.
When I see that, I'm just like, oh my gosh.
Yeah, and thankfully it was a guy that like is on the contracting side, so I could kind of give him a hard time. He wasn't like a keyboard warrior like me.
Mhm.
Like, I was able to give him some real shit, but I was pretty upset in that moment. And I couched it in humor, but like the fury was real.
Was he enjoying it?
You know what? He was having a great time.
There you go.
Yeah, that's what matters, right?
That's great.
All right, we've had our diversion. Let's get back to lending. So 85% loan to cost, 70% loan to value. Sounds like new builds is a good opportunity for me. Even if I already own the land.
If you already own the land, we can actually use the land as
part of that 15.
Yeah.
Ooh.
Yep. So you can recoup some of the land cost if you own it outright.
Yeah. I got loans.
Well, if you do, we would just roll that cost into the new loan. Yep.
Gotcha.
It's actually honestly, it's easier if you own the land already.
That's good to hear.
Yeah.
My wife is definitely going to make me do this, just so you know. Thankfully,
Cheers.
she doesn't watch this, so so that's better for me. So I don't want her to know it's possible. All right, so you can obviously do new construction. Let's talk a little bit. What the heck is a DSCR loan? Like, why would somebody want that versus, hey, Fannie Freddie exists? Why am I not filling up those 10 slots?
Yeah, DSCR is great. So DSCR stands for debt service coverage ratio, and really what I wish they would name these loans something else because DSCR is complicated.
It sounds cool though. Makes you sound smart.
Yeah, it's just an investor loan is all it is. And so all you're doing is you're taking the rent that you receive every month or the market rent that you're going to receive on this property and dividing it by what the mortgage payment's going to be. And so if you're getting $1,000 a month in rent, your mortgage payment's $1,000 a month. 1,000 divided by 1,000 is pretty easy. That's 1, right? So a DSCR ratio of 1 means you're breaking even. You're not making money. You're not losing money on that property based off just the mortgage payment. Anything above 1, you're cash flowing. Anything below 1, you're losing money on that property. We can do loans that are negative DSCR numbers or positive. They'll just make you put a little bit more money down on them.
So I think there's a lot of confusion. At least I have a lot of confusion.
Yeah.
Around DSCR. What you just said is that it's rent divided by
Market
mortgage. Market rent divided by
mortgage.
I've never categorized it that way myself. The way I've categorized it is net operating income divided by the mortgage. So it sounds like you're calculating that a little different.
We're just not taking all the net operating income.
So
right, or
you're being more generous.
We're being a little more generous because if you have a property manager, right, that's not being calculated into that cash flow.
But also repairs, capex,
vacancies,
possible utilities.
Yeah, taxes,
and insurance would be included into that in the mortgage payment.
Okay, gotcha.
So you got your principal, interest, taxes, and your PITI.
Yeah. So and where's the sweet spot there?
1.1 plus is the sweet spot.
Let me tell you, I work with a credit union and they require 1.2 or higher, but it's based on some calculation with expense ratios that are, I think, like 15-20%.
Yeah.
And so what you're talking about is much more generous.
Ours is a little more. Now you start getting into 5+ units properties, we start taking a little bit more harder look at that. But single family properties up to 4 unit properties, we're not taking anything outside of just the principal, interest, taxes, and insurance into consideration. So the question, and I saw your eyes light up when I said we'll do it, a negative cash flowing property. Why would we do something like that?
I have no idea.
Yeah.
Please tell me.
Yeah.
Please tell me.
Yeah. Expand on that, please.
Yeah. So not everybody is investing for cash flow, right? Especially with high interest rates. So you've got cash flow. You also have appreciation,
loan pay down.
Yeah.
Tax
so maybe somebody just like, I need to buy something. I don't care what it is. I just need to spend I got a 1031 exchange I need to buy, spend money on. And I'm okay. Maybe you have tenants in there. Currently you're buying a property with tenants. The market rent is higher than what the rent that you're getting on the property is right now. So technically you're negative cash flowing, but once those tenants leave, then you can raise the rents on that. So there's a lot of reasons why, we've loosened the guidelines up for higher interest rates because cash flow is hard with, when we were
impossible.
I mean, yeah, almost impossible.
Unless you were in a trash property.
Yep. Rents just haven't kept up with rates until, rates dropped and now we're back to a more normal market. So that's why, they may limit your leverage a little bit with those properties, but yeah, 1.1 is your sweet spot. Anything above 1.1, you're going to be pretty good. Yep.
That's really interesting. Like realistically, I hope anybody who's listening to this really understands the value of what you've just said. Like, that could be a 30% swing potentially in like the NOI versus the projected income.
100%.
So
you might,
like if you're disqualified by other lenders, it sounds like you might be able to get.
And these deals are really meant. Okay, so DSCR is great because we don't care about your personal income, right? Your income is that ratio. So as long as that ratio is meets the guideline, then you're approved from an income standpoint. And we don't have I don't even care if you have a job on these deals. right?
Yeah.
It's do you have the cash? Does your credit score qualify? And you're good. So there's a big distinction between conventional loans and DSCR. And I think the big misconception that we see is that conventional loans are a lot cheaper than DSCR loans. In a perfect market, that is true. All right. But DSCR loans have a feature on them that conventional loans do not. And it sounds like a bad thing, but when you think about what's going on, it's actually a really good thing. It's why a lot of people are doing DSCR, and that's prepayment penalties. Okay. So DSCR loans have prepayment penalties. And essentially what that means is if you do a DSCR loan, you pay it off within that prepayment penalty time frame, you're going to pay a penalty for the remaining balance of that. That's actually a protection for the lender, right? And so conventional loans don't have prepayment penalties. They're not protected by anything. So if I'm doing a loan and that lender's committing to funding that loan, they want some income on that property, right? Or on that loan. And if I go and refinance it in 3 months, I just lost all my income as the lender. So DSCR loans can charge a lot less up front to get that loan completed because they're protected on the back end. Conventional loans have to charge a lot in points just to get on the rate sheet. So you can get into a DSCR loan for a lot cheaper, and then we can play with the prepayment penalty time frame. If you know you're going to refinance in 2-3 years, we'll do a 1-year prepayment penalty, or a 3-year or 5-year, depending on what your long. If you're like, I'm going to do this loan, I'm not touching it for the next 10 years, do a 5-year prepayment penalty, take a little bit lower rate. Your costs on it are going to be a lot lower than a conventional loan. Golden.
That's super valuable information too. Not just in general, but like the fact that you guys do, like, I'm sure not a lot of people do that, or especially not going to explain it that way. What would, I don't know, just out of curiosity, what would, for anybody that doesn't know, what would an average like prepayment penalty be?
Yeah. So most lenders are doing what's called tiered prepayment penalties. And so let's just do a 5-year, for example. If you were to sell or refinance that loan or property in the first year, you're going to pay a 5% penalty, whatever your balance is. If you do it in the second year, it's a 4%, then 3%, 2%, 1%. So if you do a 3-year prepayment penalty, same thing, 3, 2, 1. If you do a 1% penalty or a 1-year prepay, it's just 1% penalty in the first year, nothing after that. So your rates are better. The longer prepayment penalty you go to, the shorter prepay, you're going to take a slightly higher interest rate. And usually there's about a 0.5 point gap between that 5 and 1 year.
You've done a good job of selling prepayment penalties to me as a win. I can actually believe that.
Yeah.
And I think fundamentally what you need to do as an investor is determine what your strategy is going to be and whether or not that makes the most sense for you. Because there are a lot of houses I buy and I decide to refi and hold that I'm not convinced I'm going to hold for 5 years. Like I'm pretty confident I'm going to do something with it in the next 1 to 3. And so that's a situation where I might be willing to pay a little bit more from the interest perspective to not pay that.
All you're doing is looking at a break-even point, right?
Yeah.
So if you take let's use easy numbers. Let's say you have a $100,000 loan and you have a 3% penalty. Well, if you pay that off, it's $3,000 that you're going to have to add on to your payoff when you sell or refinance that property. But if the payment difference by going to a 5-year or a 3-year is $20, right, over 36 months, what, can't do math, but $6,200, is that right? Something like that.
Sure.
Somewhere around there. It's so you just got to do the math on wherever that break even point is.
That makes a ton of sense.
$620 would be not $6,200. So for you to go to that, if it's that example, if it's only $620 over 30 years and it's a $3,000 prepayment penalty, you're gonna take the smaller payment.
Yeah, for sure.
Yeah, realistically, people who are going to do the DSCR are probably not thinking like you. Like they're probably thinking that they're going to keep these properties for a long time. So it's.
I have a question though.
Yeah.
For anybody here who's got investment properties, who here has an investment property that they've owned for more than 5 years?
2, 1.
Okay. I always have the intention of holding them for a long time, and then something happens.
Well, what do you think the average time that primary people hold their mortgage?
I have no idea.
7 years.
That's
I do
way
remember.
less.
I knew it was under 10.
Yeah, 7
Yeah.
years is they're either moving or refinancing, and it's 7 years.
I
is the
bet you it's going
average.
to be longer for this next cycle. I bet you that goes up,
Yeah, it has
Well, that would
to.
make sense. Yeah.
given kind of what we're talking about. Like for instance, for us, like we are stuck unless my
Well,
wife. makes me
and
build this
so
house.
and that brings up kind of going back to your new construction question. The problem with our industry right now is there's no houses on the market because there's no new construction.
Yeah.
Right. And so there has to be new construction, not in the 700,000 plus range. We need 250 to 300 new, and there's nobody building $250 to $300,000 new construction projects right
So you're
now.
telling me I'm going to crush it on those townhouses?
Dude, if you will sell it immediately, guaranteed income, you can. No, I'm kidding. Yeah.
Yeah, but you're probably
new construction has to happen in that price range for the first time home buyers.
Yeah. Well, the interest rates just crush that for a little while. So
yeah. And it's easier for you because you get to. I mean, it's probably harder for a lot of other people. Like if I went to you and said, I need to build these for 250, you're gonna be like,
yeah,
Yeah.
good luck.
Yeah,
Yeah.
okay.
I mean, yeah, my cost of construction is going to be better.
Yeah.
Than most of them.
yeah. So you're in a great position to do that.
Yeah.
for
Well,
sure.
as are like Fisher Homes and stuff like that, where they can go and negotiate that stuff.
Yep.
Yeah.
Where they've got the in-house crews for the most part. So,
Mhm.
all right. So we've talked about the SCR. We've talked about new construction. What else should we talk about here from a lending perspective?
Man, I think hard money. Hard money is
What is hard money? And what's the difference between that and private money?
Why is it hard?
Yeah.
Why isn't it soft? Why isn't it soft?
yeah, hard money is just where you're buying a property that's distressed, that needs rehab, needs a little TLC on it, and we're going to finance the rehab on it. So you're going to force equity in that property. And I think it's important because it's kind of going back to new construction. You're taking these properties that nobody wants to buy. They don't want to put the time and effort in because there are primary loans, right? For somebody to go buy a property, rehab it, and make it their own.
I was literally going to ask that question.
But if you're a first-time home buyer, that's stressful. Like I wouldn't have done that as a first-time home
never
buyer.
for a first time.
Especially if I'm younger and I have no construction experience. Like maybe that's something you want to take on, but it's a great opportunity to buy that distressed property, put some money into it, fix it up, and then sell it, whether it's a first-time home buyer to another investor or whoever it may be. But you're basically taking existing property instead of new ground-up construction and redoing it and making it nice. So those deals have been just a crazy hot commodity right now.
Mm-hmm.
Yeah.
So what are what are the majority of deals that you're doing in terms of lending right now for investors? Are they mostly hard money? Are they mostly DSCR right now?
So we do a lot of hard money. We're doing a lot of DSCR refinances currently, where people bought earlier this year. We've seen a lot of people put houses on the market, and they can't sell them right now because their rates. So hopefully, since the Feds dropped rates and our rates are dropping, that the people that are trying to flip properties are going to see a little bit more traffic to their properties, because there's a lot of people that had the intention of selling, and they're like, our property's been on the market for 60, 90 days and we just can't get it sold. So now they're coming back to us to refinance to get out of that hard money loan.
Are you seeing a specific price point where that's happening the most?
Ironically, the lower price points.
I was going to say,
100 to 150,000
Yeah.
is hard to sell right now. It's the higher price points are easier to sell.
Those are less price sensitive.
350,
Like 350, 400K.
Yeah. Okay.
Yeah.
So what I noticed for a while is when rates were climbing, like 2023, it was the entry level really sucked, and then like the 200 to 300 was fine, and then that 300 to 500 was dead, like that middle of the market for whatever reason. But that was only 2023.
Well, you got to think like that price point.
That's a step up buyer.
Yeah, it's a step up buyer, and you also have your bedroom bathroom count is usually maybe like 2-1. 2-1's a hard one to sell, right? 3-2 is an easy one to sell, or easier, I should say. And so there's a lot of different factors that go into that, but obviously a 3.2 is going to be just a slightly higher price point than a 2.1. So just kind of depends. We've started to see a lot more turnkey purchases as well.
Interesting.
Oh, that's
Because that was
I
dead
didn't think
for a
about
while.
that.
It was
Yeah.
dead. And we've seen it in some unique markets too, like not in Indy right now.
Like Anderson, Kokomo.
Anderson, Muncie, Newcastle, like markets that are. So one of the things we have now, which is a blessing and a curse for us, is that we can do DSCR loans down to no minimum loan amounts.
Jesus.
Right. And so like we're doing one right now, purchase price in Muncie,
$22,000.
$55,000 purchase price.
Yeah.
Our loan amounts, underneath 50K.
We have to for some of those markets.
Yeah. Yeah. So it's a great opportunity. And
Before we got here.
yeah, and rents are decent in those areas, so they can go purchase property, get seller credits on these properties, so their cash out of pocket is just very minimal.
Nothing almost.
Right.
Yeah.
A 20% down payment on a $50,000 property is $10,000. So you limit your out of pocket cash flow at a pretty good rate. Yeah, those markets, those kind of off markets that haven't really been touched, they're popping right now.
I would say our best buyer wants everything in Anderson right now. Really,
Anderson's great.
That's one of his favorite places to buy. Certain areas in Anderson, obviously, but
yeah, and I've heard from other buyers as well. They're looking more into Kokomo now, and
Kokomo's an interesting one because of the Samsung.
Yeah,
that's moving up there.
Yeah. Plus, there's so many homes out there to fix up.
Yeah,
it's an interesting one.
You can still get in cheap, and yeah, people are doing okay over there.
Terre Haute's another one. Fort Wayne.
There's nothing in Terre Haute.
Man, we have some buyers. That's all they buy. It's Terre Haute.
It's because Alicia's a really good saleswoman.
Alicia's amazing.
Yeah, Alicia might be the best saleswoman I've ever met. But yeah.
What about as far as like doing appraisals on this stuff? Are you doing I know we've worked with certain lenders that do drive-by appraisals. Other ones do like a full-blown one.
Desktop.
How does it work for you guys?
All of ours are going to be full appraisals. Depends on. Most of the time, we can use an in-house appraiser. Other lenders that we work with require to go through a management company. We'd have a little less control over it, but they're all going to require some sort of full appraisal. There's also another thing that we require on all DSCR loans is what's called a CDA, or a collateral desktop appraisal, which is essentially a third-party review of the appraisal. So once an appraisal comes in, we have to order this separate report that just says, yes, everything is good on this. And every once in a while, we'll see that collateral desktop review will come in a little lower or a little higher. But 90% of the time, it's not a big deal.
Sounds like it's not an issue if it's higher.
It's not an issue. It's only if it's lower, we have to go off the lower. But just know if you're doing a DSCR, there are some additional things that have to happen. It's a less than a 1% shot that you have any issues with it. But
gotcha.
Cool.
Well, what is the best way if people want to get in touch with you or the rest of the team at Mamba to get their next DSCR hard money loan, new construction loan?
Absolutely. You can always visit our website, mambamortgage.net. You can email me.
Don't forget that.
.net. This guy, so somebody owns
someone's hijacking.
Seriously, Mamba Mortgage. It's taken me a year. The guy finally reached out to me, asked me, hey, he's like, hey, make me an offer. I'll. And so I was like, I don't know, like
$10,
$25. And he goes, good luck with your future endeavors. I was like, you told me to make an offer, like
it's like,
no
I don't
counter offer at all. And he,
don't even know what the starting point is for this.
So so mambamortgage.com, it's on the radar, but mambamortgage.net right now is I like where we're at. My email, Jared, Jared @mambamortgage.net. Those are probably the two easiest ways to get a hold of me. For somebody on the team.
In the new office down in Refinery 46.
Refinery 46. We're
new office for now until you
add
more.
Do more
people.
Nope. I'm done moving. Done moving right now.
So you say you're done moving for 2024.
2024. Yeah, we are definitely not moving 2024 again.
Well, awesome, man.
Thanks
for coming on.
Yeah,
again.
Thanks for having me.
Yeah,
this is awesome.
That's a wrap, fellas.
Yeah, that's it. I don't see any new questions.
Kaya decided she didn't actually want to hang out with us.